Casey Boland is joining me now. Casey's with Hanghold Capital Management. And Casey, we're in a time here of low interest rates, and there are, if you look historically, there are certain stocks that perform better during periods of low interest rates.
Yeah, I think history can provide some guidance here. Back in the late 1940s, interest rates were capped by the government at low levels to help the country manage the enormous debts accumulated during World War II. So the Fed was keeping rates just north of 1%, a level that was below inflation. Sound a bit familiar? High debt, low interest rates, low inflation.
So you come out of World War II, and in the 40s, of course, rates were still low. What was paying well then, 40s, 50s?
Well, dividend-paying stocks did well during that environment. So during the 1940s, dividends offered 70% of the total returns of the market. In the 1950s, they continued, though. About 40% of the total returns came from dividend-paying stocks. Bonds had a performance period there where they were doing better than stocks, and then they shifted back to stocks again. The Fed lifted the cap on interest rates back in 1951, and stocks had a string of years of outperformance versus bonds.
Well, of course, they could raise interest rates a quarter point again, but they still would be relatively low, correct? So what do we look at down the road?
Definitely. We've had these emergency provisions in place for such a long period of time. So at some point, the Fed will be raising rates. And, we've had a similar historical pattern. We had a period where bonds outperformed stocks. Then stocks started to shift and outperform bonds. Companies that pay nice dividends that perform well. And, again, with history, if we see this trend suit and follow as the Fed lifts rates, the advantage still should be with dividend-paying stocks in the next few years, and we should see the market continue to outperform bonds. Look to dividend growers, though, versus high-yielding dividend companies.